Hey everyone, Couch Investor back to another video for today. So as promised, a follow-up on the last video about Intel, talking about whether or not Intel might split their business. An analyst said that he thinks that's the way to go. So we got more comments, more information from the CFO, from the CEO on that. I'm going to touch on that in this video, as well as two comments from analysts, one a bit positive and the other a bit negative. And then at the end, we're going to have a look at the graph, some interesting things there to see. Now, with regards to a spin-off, not a spin-off, in my opinion, I don't think a spin-off will happen of the Foundry business. I don't think we'll have Intel, the Foundry business as an investment, and then Intel as the product line, the CPUs, GPUs, etc., as a separate business. I think they will still stay under the same Intel model as we've seen right now. But yes, as they said, it will be different in the P&L. You will see a clear differentiation between the Foundry and the internal Foundry model and the rest of the business. I don't think we're going to see a spin-off like we will see with Alibaba and the cloud business, for example. Now, we did have some comments here. This is, of course, a transcript. It's a very long one, but I'm just going to touch on the important things that I want to touch on in this video. So a quick recap here. We first discussed the internal Foundry model in Q3 of 2022 as part of a multi-year cost efficiency effort, which includes reducing costs by $3 billion already this year, so 2023, and $8 billion to $10 billion exiting 2025. As discussed in Q1 earnings, we're on our way to achieve $3 billion in savings this year, including $2 billion reduction in OPEX and $1 billion reduction in cost of sales. We'll provide another update when we report Q2 earnings. Of course, there's also a dividend cut. And I continue by saying here, the internal Foundry model is a key enabler of the incremental savings to achieve our $8 to $10 billion we previously committed exiting 2025, and is critical to our longer-term ambition of 60% gross margins and 40% operating margins. As we transition to the internal Foundry model, the manufacturing group will be accountable to a standalone P&L for the first time. This is a shift from today's practice where cost is allocated from the manufacturing group to the business units. Pricing will be based on the comparable industry benchmarks from foundries and OSATs based on performance, power, area, and cost. This will provide an economic relationship akin to a fabless and foundry partner and shift the association from today's support model to a customer-supplier relationship. And so they said here, as we transition to the IDM 2.0, the manufacturing group will have a standalone P&L. Revenue will be based on wafer sales to the business units at market pricing, while cost will continue to be based on true manufacturing costs. As such, the manufacturing business will begin to generate a margin. And then they say here, Intel's gross margins compare unfavorably to industry benchmarks. Leading fabless and foundry competitors combined into a virtual IDM would achieve roughly 70% gross margins, which is 20 to 30 points higher than Intel's recent results. We took a big step forward this year as part of our efforts to reduce spending. And it is very, very true. Again, if they manage to achieve their goals, today's prices are a bargain. Again, I'll repeat it. That's if they manage to achieve their goals. There is still a long, long way to go. Execution is key. And our last thing here, and this is something that we should not take for granted. I don't know who this is going to be, but we can speculate. They say here when talking about the Intel 18A, in fact, we continue to be confident that we will sign up our first Intel 18A external foundry customer this year. Remember, not so long ago, we talked about the fact that Jensen Huang said that he talked with Pat and he got already some, let's say, pre-released, some test units. And he said, looking pretty good. Now, again, I don't know if this will be NVIDIA. Maybe there are some other big companies that they are already talking about or working with or potentially working with. But if you put the puzzle pieces together, I think the odds are in the favor of this will be NVIDIA. Remains to be seen. I guess we'll have to wait until the end of the year. Now, if you're enjoying this type of video so far, leave it a thumbs up, subscribe if you have not. I would really, really appreciate that. And I appreciate all the support you've all been giving these videos lately. Thank you very much. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now let's touch on the two analysts, the positive and the negative one. I'll start with the negative. So this is a comment from an analyst at Citi Research. He said, Intel would be best served by exiting growth businesses that in our view, it has little chance of succeeding in and focusing on its core CPU business. He thinks Intel should consider going back to basics. Continues by saying, in our opinion, this will likely just create a bigger, more complicated problem when talking about breaking off the Foundry business into separate line items next year, adding that the push into Foundry capabilities detailed further during the Wednesday investor event seems like the wrong move. He then said that Intel is suffering largely from self-inflicting woes, which I agree, and we've talked about that plenty on this channel, but things are getting better, and I don't think that the Foundry road is the wrong move at all. By the way, Intel has already exited many of their business in the last year or so. Now, he continues by saying here, we believe the primary reason Intel has fallen behind TSMC in manufacturing is delays at Intel, not an accelerating roadmap at TSMC. We see the main reason Intel's margins have collapsed as higher spending, lower margins chasing revenue growth in Foundry and other areas where we believe it has little chance of success. Intel stated its capital intensity has climbed from the high teens to a whopping 40% due to chasing growth. Well, what did you expect? What did you expect, that this is going to be easy? No, they're trying to do something that will transform this company completely. Of course, if you don't believe in it, then yes, you'll be bearish. I believe in it, that's why I've put my money where my mouth is. Then on a more positive note, we have here an analyst at Benchmark. He says here, we believe this new reporting and operating structure will optimize the company's cost structure as it will change the incentives for leadership and change the behavior within each business unit. The further separation of its Foundry manufacturing business provides much needed transparency. The analyst says the model should reduce disruptive rush chip orders, lead to more efficient test time planning, and lower the amount of expensive redesigns, as Intel Products Group executives would directly be responsible for the higher cost on their financial profit and loss statements. Again, this is going to be an internal competition, which is always pretty healthy. He is also optimistic the structure will allow Intel to better assess the cost of its decision among the chip giants' business groups. This new supplier-customer relationship will increase each business unit's expense visibility and accountability with a direct comparison of the financial performance to its industry peers. I agree here, and that's why I'm still holding my shares. Intel also said that using the internal foundry will have its incentives as well. Of course, they're allowed to use external foundries, but using the internal ones will have incentives. Now, before I end this video, let's have a look at the graph. So on the weekly basis, we can see, of course, this week wasn't that great. We tried to go over that $36, $37 mark here. We tried to go a bit higher here, didn't succeed. But if we look at the RSI, still pretty neutral, MACD still bullish, and still on this candlestick right here, we did finish above the 20, 50, and the 200-day moving average. In my opinion, this was bottom $25 3 times already. Then now if we can make $30 our next support line, I'm not saying it's going to go back down there, but it does look like previously this was resistance, and now we might be using this as support if the stock continues to go down. Developments there in Russia with the Wagner Group, etc. Things can get pretty crazy very, very fast. Remains to see what happens. Let's try and make maybe $30, a little base here. And then, of course, in July, we'll have the Q2 earnings report. Much more information will come out of that. And so that will be it for this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.